We have Brian Birch back with us from the Financial Aid Office, and he is going to be focusing on student loans. So he's going to be taking a look at student loans and the parent loans, similar to the format yesterday. If you have any questions, throw them in the chat, and he can get to them at the end of this presentation.
Hi, everyone. Thank you, Sophia. I appreciate it. So again, welcome to, which is the second of our financial aid presentation. So as Sophia said, we're going to talk about loans. They can be a little, not scary, but how I present it to families is you go to college and take out the loans to pay for the degree, to get the job, to pay back the loans. It's kind of a vicious cycle that we all have to go through, unfortunately. So this is going to be an overview of the federal loan process, who qualifies, how do we qualify, what do we have to do? So please, if there's any questions, put them in the chat and we will address them at the end. So here's our agenda. We're going to take a look at the different types of loans, who is eligible. There are some requirements, some paperwork that needs to be filled out. Entrance counseling, exit counseling. We will go over repayment options, as well as deferments, forbearances, and default. And then we will talk briefly about some programs designed for actually loan forgiveness that will allow students to forgive a portion of their loan balance. So we're going to start with the two types of federal loans. When you hear people talk about federal loans, generally this is what they're referring to. So the federal government offers two types of loans to students. The first one is a direct subsidized. The second is a direct unsubsidized. And the word direct, what all that means is the student is borrowing directly from the Department of Education, okay, i.e. the federal government. So the difference between the two is with the direct loan, as the slide says, the government will pay the interest for the student while they're in school. The only requirement is that they're working towards a degree and they attend at least half-time. So generally speaking, a full-time student is 12 credits. Half-time would be at least 6 credits. So the interest will be paid while they're in school at least half-time, as well as when they're in their grace period, or if they need a deferment. The grace period is the time after when a student graduates or stops attending. It's 6 months, and they do not have to make any payments on that loan during the grace period. Deferments can be a couple different reasons. We're going to talk about them in a later slide. The second loan is the direct unsubsidized loan. This loan, the student is responsible for the interest that is dispersed while they're in school. So it's a generous interest rate in terms of how low it is. I believe it's 3 point something percent for the unsubsidized loan. So we're not talking about a lot of money, but the interest will start to accrue on that loan balance while the student's in school. Now, students do have the option to make payments. It's not required, but they do have the option to make payments on that interest while they're in school. On a $2,000 loan, which is generally the amount a student would receive, interest is maybe $10, $15 a month. But by paying that interest while you're in school, it stops that amount from capitalizing, and it will reduce the overall amount that a student will have to pay over their lifetime. Okay, so here's kind of an overview, some important points about the federal education loans. The loan is awarded to the student, all right, and paid by the student. The parents are not involved. Parents have a different loan that we're going to talk about in a little bit. So the two loans from the previous slide, the subsidized and unsubsidized, those are for the student and repaid by the student. There is no additional application. The application actually for the federal direct loans is the FAFSA. So when you fill out the FAFSA, you're not just applying for federal grant money, which is the free money, but you're also applying for the federal loan program. There is no credit check to qualify for the direct loan. As long as the student fills out the FAFSA and they're not in default of a prior loan, they will get this loan. Okay. They may delay their payments after college. I mentioned the grace period. They can actually use that time to make payments, or if a student is still looking for a job and doesn't have any income, they can use that 6 months to defer their payments until that period is over. As I mentioned, students must complete the FAFSA for eligibility. And a lot of times I'll get questions, well, what happens with this loan money? Where does it go? Loan money goes directly to the college. It is not sent to the student or family. What happens is the college will put the loans onto an award letter that the student receives, and it will list the type of loan and for the amount. So everything in terms of disbursement, receiving the loan, that's all done behind the scenes by the financial aid office. So typically, a freshman will receive $5,500, and we'll talk about amounts in a little bit. That money is split between 2 semesters, one half going for the fall, and then one half going for the spring. Okay, here are some loan limits that, these are standard amounts, and they're set forth by the Department of Education. So if you see here a freshman entering, the maximum amount that they can receive is $5,500. And going back to that first slide with the subsidized and unsubsidized, $3,500 is the most that they can receive in the interest-free loan. The additional $2,000 would be unsubsidized. And you can see now sophomore, as they increase in class standing, they do get a little more money. So sophomores can receive $6,500, and junior and seniors can receive $7,500. Now, there is another column here for independent students. If anyone attended yesterday's session, students can be either dependent or independent. It all is a matter of how certain questions are answered on the FAFSA. So if the student answers yes to one or more dependency questions, they're considered independent. They would need to provide proof of their independent status, but you can see how an independent student does receive more money than a dependent student would. The thinking is that in a lot of cases, the independent student does not have parents to help subsidize the cost of affording college. So that's why they get an increase over a more traditional dependent student would. We talked a little bit about parents. Parents have their own loan that they can take out. It's designed to be taken out by parents for an undergraduate dependent student. All right. If we remember, the last slide talked about independent students. Independent students are not eligible for the federal parent loan. Only dependent students' parents are. And you would ask, well, why would a parent have to take out a loan? A lot of times that $5,500 is not going to cover the cost of tuition. Okay, it might cover it at a community college, or maybe a junior college, but a lot of four-year schools, the $5,500 is just not going to pay it. That's where the parent can apply for a loan in their name. They would be responsible for repaying it, but it would actually cover the gap that is not covered by other aid. Again, families must fill out the FAFSA. The application, there is actually an application for the Parent Plus loan, and they will do a credit check. All right. Now, it's not as intense of a credit check as with, say, a private bank. As long as there aren't any derogatory remarks, and I say derogatory, meaning bankruptcies, collections. If your credit history is free of those, you should get approved. Again, I can't speak to every circumstance, and the Department of Education does not give us the criteria. They just let us know that generally parents are approved unless they have real blemishes on their credit history. There are no income requirements. So even if you have a low income, you can still qualify with a healthy credit score. A lot of parents will ask, oh, well, if I take a loan out in my name, can my son or daughter pay for it? The answer is no. The parent cannot transfer their loan balance to the student. Now, if there's an informal arrangement made between the parent and student, that's fine. The school would not get involved in that. I've seen it before where the parent and student come to an informal arrangement where, yes, I will take out this loan in my name, but you are going to have to help pay it. But that's a discussion between families. So really bottom line is, in the parent plus loan, the parent is responsible legally for repaying that loan. There's also a private loan option available to families. So private loans are not offered by the Department of Education. The prior loans that I spoke about, the subsidized, unsubsidized, and Parent Plus loan, those are all federally insured and backed by the Department of Education. Private education loans, though, are not. They're offered by private lenders, which include banks, credit unions, online companies. Just to give you a few, Citibank, Sallie Mae, Discover, Wells Fargo, a number of credit unions, all offer private student loans. So for a private student loan, you would choose a lender, fill out an application, and you would go through a pretty extensive credit check. It's almost like applying for a car lease or a credit card. So they are going to, really look at your FICO score and your credit history to determine if you're approved or not. The one small benefit of a private loan is that the student can apply for the private loan, but they will need a creditworthy cosigner. So I've gotten asked before, well, why would a student want to take out, a private loan when maybe their parents can? A lot of times parents are not financially in a position to take on debt, but they are willing to co-sign for a loan. So sometimes parents are looking at retirement or looking at buying a new home or moving, or they just know that they're not going to be able to afford the monthly payments if they put a loan in their name. With a private loan, the student would be the primary borrower, and their parent or a family member, a brother, a cousin, they could also be considered co-signers, and it would look at their credit to determine if the student is approved for the loan or not. The interest rates, they can be high. Conversely, they can also be lower than a federal parent loan. The interest rate is going to be determined by the credit score. So the better the credit score, the lower the interest rate. Private students loans, they usually don't come with as many protections as a federal loan does. And protections, what I mean by that is, even for me, I'm repaying my graduate loan right now. And because of the pandemic, I haven't had to make a payment in almost a year. But private companies do not offer that type of assistance to its borrowers. They are still requiring monthly payments, even though the economy is in the state that it is. The repayment terms are not as flexible as a federal loan. Federal loan repayment plans can range anywhere from 10 years to 20 years. The repayment terms for a private loan are a little bit more stringent in terms of their repayment years. So going back to the federal direct loans, there are two documents that would need to be filled out by the student if they're going to accept the federal direct loans. The parents would need to do this as well if they're doing a Parent Plus loan. The first form is called entrance counseling. All this does is this makes the student and or parent understand the responsibilities of taking out a loan. It will go through and ask a series of questions. There's a small quiz before you complete it that you'd have to successfully complete. It's basically just letting this, that it is a loan. It does have to be paid back. It offers information on what happens if I can't pay the loan, what happens if I have a medical situation that's preventing you from working. So it does kind of go over the entire loan agreement. And all schools will require this in order to disperse federal loan funds. The next document is called an NPN, Master Promissory Note. A lot of people have to fill one out when they buy a car or some other type of loan. Same thing here. The borrower would need to complete a Master Promissory Note, which is, in a sense, your promise to repay the loan to the Department of Education. And it also tells the department what school you're attending. Okay. And finally, the last bit in terms of forms is exit counseling. So once a student graduates or leaves school, or they're not enrolled at least half time, by law, they're required to complete exit counseling. And the exit counseling, that just kind of sums up their entire loan history. They will be able to access their loan balance, see how much they borrowed, view repayment terms. They will also review their rights and responsibilities. It will show them how they're making payments, who they're making payments to. So it's kind of a summary of a student's financial loan history at one school or at many schools. It does a good job of capturing everything that the student will need to know in order to set a budget for themselves to make payments. So now we switch kind of over to repayments. I mentioned that there is a 6 months grace period from once you stop below halftime or graduate. Midway through the grace period, students and parents will receive notification from their servicer. Now, what the servicer is, the government is the institute that does the lending. The servicer is the company that is responsible for sending out invoices and actually collecting funds. So what happens is the federal government really gives all of the students loans over to, I think it's 6 or 7 different companies. Those companies then are responsible for reaching out to the student to set up a repayment plan. Any questions the student has about repayment, about direct deposit or direct debit from their checking account, any type of forbearance, if they go back to school and want to put their loans into deferment, they would actually reach out to their servicer and not the federal government. Currently, there are 8 different repayment plans. Some are based on income. Some are based on the profession. If you work in nonprofit, you might have a different repayment than others. There is a standard repayment plan. There is an extended repayment plan. So all these plans are highlighted in that exit counseling that I just spoke about. And the servicer will be able to direct the student to the correct payment plan that best suits, 1, their income, and 2, their ability to pay. So as we know, things happen in life. And, a lot of times they're beyond our control, but the bills are going to start coming. Deferment and forbearances are a way for the student to really postpone or reduce their federal loan payments. The difference between the two is in a deferment, no interest will accrue. Right now, that's what a majority of Americans with loan payments, we are in a deferment due to COVID. So no interest has been accruing on these loans. If you were in a forbearance, interest will accrue. For an example of a forbearance is a student that graduates from four-year college or even an associate's degree from a two-year, might go out and work some and decide they want to start their education again, either to earn a graduate degree or a PhD or even a bachelor's degree. So that is what's called an in-school forbearance. Students do not have to make payments because they're enrolled in school again, but the interest will continue to accrue on that balance. And default, obviously, that's language used in a lot of different loan instances. Default just means that you fail to make your payments on time, and ultimately those loans could go to a collection agency. Just like if you were to not pay on a credit card or a car loan or any type of anything to do with you owing money to an organization, medical falls under this. If they don't get their payments on time, and if payments are missed over consecutive months, they will go to collections, and it will negatively affect the credit score of the student. And we know how hard it is to get your credit score up. So that's why I encourage all students that if you can't make a payment, if something happens, reach out to your servicer. They are there to work with you. They are there to try and get the payments to an affordable amount. They're not going to reach out to you other than to say that your payment is late. It's really up to the borrower to bring their situation to the servicer to see what can be done. I've seen instances where loans go into collections. They can garnish wages. They're allowed to take away any tax refund that you might get after filing your taxes. So we really want to encourage students to do whatever they can to not be in default. It will not allow them to borrow future loans if they go back to school until they get out of default, which can take some time. So default, we really want to try and do as much as possible to not fall into that situation. There is, lastly, some ways for students to get some of their loans forgiven. The major one I'm going to talk about is called Public Service Loan Forgiveness Program. This is something that I'm actually in myself. Because I work at a university, they are considered nonprofit. And what happens is I enroll, or the student enrolls in the Public Service Loan Program, PSLF, and the servicer will set up a payment plan based on your income. So obviously those making 80 grand are going to pay a little more than those making 40. It also looks at the amount of loans that you actually have. Once the student makes payments for 10 years, 120 payments, any balance on that loan is going to be forgiven. Okay, just to give you an example, and I'll use myself. Once I'm done with my, and I still have a few years, once my public service loan program is done, the government's going to forgive, I think it's like $20,000 of my student loan balance. So that's, really great for anyone that's able to get into this program and complete it successfully. Again, it is regulated to non-profit organizations. So if someone goes and works for a bank or any type of non 503c, that's called a nonprofit code for the IRS, they would not qualify for this program. But there are other ways. I've seen students that sign on with companies that do offer bonuses that will be paid to their loan balance for signing a contract. For example, some students might work for a financial institute. If they might give you the option to sign, say, a 4-year commitment to working for that company. At the end of 4 years, they will give you X amount of dollars that you can use towards your loan balance. So again, that varies from industry to industry, but there are ways to really get some of your loan balance forgiven. Teachers have this option if they enroll in the Teach Grant program during their undergrad and they work in a certain area, they will have a portion of their loan balance forgiven as well. And New York actually has their own loan forgiveness program. It's called Get on Your Feet program. So this program provides 24 months of debt relief to college graduates who are in the income-driven plan. And that, again, is specific to the company, whether they participate in it or not. But it's just something for students to keep in mind when it comes to student loan forgiveness, that there are ways to forgive balances. So my advice, student loans, they are a necessary evil in a lot of ways, but they do help the student establish a credit history. And we all know how important that FICO and credit score is. So a student loan does help establish credit history. It helps a student establish a monthly budget. If they're thinking about moving out and getting their own apartment, they will have to account for a student loan payment. So it does help them hopefully become conscious of their budget and budgeting their income and making payments and establishing credit, which will lead to, hopefully a house or a car. And again, that FICO score is going to determine the interest rate. Students can track their borrowing through the studentaid.gov. Students can actually log in and see their history. The only thing it's not going to show is their private loan history. Pay interest as it accumulates. I do advocate to have students pay as much as they can while in school. And it's not a lot of money. It doesn't have to be a lot of money, but if they're paying that interest, it's not going to accumulate. And then lastly, I always advocate borrow what you need. If your bill is $5,000 and you need to borrow, colleges do allow students to borrow more than what they need, and they would get that as a refund. So I understand books are expensive and supplies, but I do advocate to borrow only what you need and really try and keep the debt as low as possible. So that's just kind of a brief overview. I think I've highlighted the major, major points in the federal direct loan program. So now, if anyone has any questions, please feel free to let us know.
Hi, Brian. I have a question.
Hi, Anna.
I know typically students who are independent don't necessarily get as much financial aid. First question is, do you know why the reason that is? And second question, is that the reason why they're able to take out more loans?
Well, I've seen in my experience, independent students get more, believe it or not. And I'll tell you why. So there's really 5 questions that a student would be asked to determine their independent or dependent. Are you over 24? Did you graduate from college? Are you a parent of a child? Are you married? Are you a veteran? So if a student answers yes to any of those, they're considered independent. So when they're considered independent, they're not including their parents' information. And not always, but typically students aren't making as much money as, someone, that's been working for a while. So typically the student or the FAFSA is only looking at that small amount of income from the student. They're not looking at anything else. And unless a student is making 30, 40, 50 grand a year, which isn't always the case. It happens, but it's rare. The lower the income usually translates into more financial aid. And the reason that they have higher loan amounts is because they might not have that parent to take out the Parent Plus loan. Okay, so that's the reason why they're able to get more money than a more traditional dependent student. Dependent students most of the time can ask their parents to either co-sign or do a parent loan, but independent students not always have that option. The thinking is, well, if you graduated from college, you're independent. You should be able to hopefully find a job. And we don't need your parents' information. And if you're 24, that's the other cutoff. You don't need your parents' information once a student turns 24. So, Brianna, just in my experience, unless the student is, has been working for a while and has some type of salary job or works a lot of overtime, they usually do get a little more aid than a more traditional dependent student would.
That makes sense. I don't know where I heard that from, though.
No, that's okay. There's a lot of myths about financial aid out there, a lot of misleading, I heard this, and a lot of times it's just not true. That's why I encourage, come to us. Even if you don't end up coming to Binghamton, that's fine. A lot of this information, actually all of it, pertains to almost any school in America. So this is a service we're doing just to educate people about the FAFSA, about loan questions. And, we would obviously love everyone to come to Binghamton, but we know that's not reality. We just want to do our best to educate people with the process.
Thank you for that.
You're welcome.
It looks like Wendy asked in the chat, what are the options to repay early?
Sure. So we can definitely repay early. I highly encourage it. So that servicer that I talked about, they're going to reach out to the student and they're going to say, okay, we are your servicer. We are going to be handling the billing, the monthly billing, the collection of payments, your repayment plans. So whomever is assigned to that student's account as a servicer, they can actually set up payments ahead of time. Now, you're not going to know who your servicer is right away, but the student and or parent can go on to that student aid and they could log in and they can actually see who their servicer is while the student's in school. Okay, it's one of 7 companies. Great Lakes is one, Nelnet is one, Navient is another one, Pennsylvania FIA is a servicer. So while they don't formally introduce themselves until after the student drops below half-time, because that's when repayment is going to officially begin, but parents and students can log into the student aid portal and they can actually see who their servicer is. And if they don't know, they can reach out to their financial aid office and they will be able to direct them to the right place to find out how to make in-school payments. Did that answer your question? Good.
I don't really have any questions, but I just wanted to come on and say thank you for the information session. I really appreciate it, and I did learn a lot.
Good. I'm glad. Thank you for saying that. We appreciate it. I've been doing this, a long time, and I like doing presentations because financially it can be confusing. It can be very confusing for parents, for students. It is something that there's a lot of language that isn't always correct. So, it's our job as financial aid professionals to really go out and educate as many people as we can about the process and answer questions. And, the financial aid office is not something to be feared, believe it or not. A lot of students are hesitant to reach out because they just don't understand. But we are here and I've been in a couple schools. We have office hours. Students can come in at any time. They can call. During the pandemic, we've been working from home, but we actually have every day we have Zoom sessions available for students. So don't be afraid to reach out to your financial aid office for any questions. I see here, is there a penalty for early payoff? No, there is no penalty. There are only benefits to repaying your loan early. As we mentioned, if you start making those interest payments, that interest is not going to accrue. And if you pay a little more, anything you pay above the interest is going to go towards the principal. So I've seen some really, really good students that are, they don't want the debt. They will take money that they earn over the summer, and make a payment on their loan. A lot of students work study jobs or a part-time job in college. Even if you were to just take $25 a month, and just start paying down your debt, you will see that when you're done with school, you're actually saving yourself, if not hundreds, then thousands of dollars. Interest is a beast. For those that don't know much about it, and I don't claim to know, everything about interest, but the way it compounds and accumulates and capitalizes, just to kind of put it in perspective. So if a student borrows the maximum amount for the 4 years, all right, they are borrowing $27,000. All right, doesn't sound like a lot. It's a new car. Really, what they're doing is that $27,000 equates to a new car. But if they don't make any payments, by the time they get done paying the $27,000, they actually end up paying more like $35,000. Okay, because the interest continually accrues and continually capitalizes. And that's just the nature. That's how banks make money. That's how the government makes money, is off the interest. Let's see. Amy asked, should a student receive both a school scholarship as well as private scholarships? What happens if the student is granted more money than the cost of the school? Typically students, so every college has what's called a cost of attendance. So the cost of attendance takes into account tuition, fees, room, board. It also takes into account things that do not appear on the bill. Books are not on the bill. That's something the student pays out of pocket. Transportation expenses, that is not billed by the school. If for some reason the student has more money in loans and scholarships than what their bill is, they would actually get a refund. So, for example, we'll keep it simple numbers. Tuition, room, board, and fees, all right, for XYZ college is $20,000. The student might have a merit scholarship for $15,000. They might have a small federal grant. They will be offered their federal student loans. So say they have $25,000 worth of aid and the bill's $20,000. So that excess $5,000 would actually go back to the student. They could use it for whatever they want. If they want to turn around and use some of that to pay off the loan, or they can just decline the loan. All right, if they decide that they don't need it. A lot of times students that do well with scholarships don't actually have to take out the loans, but they are there, and students can use that refund for books, for spending money, for whatever they want. It's their money to do with as they choose. They would get that refund typically as a direct deposit from the college directly into their bank account. You're welcome. Well, that was a great question. These are all great questions. So even if you have a question not about loan, we do have some time that, if you have a FAFSA question or any type of situation, please let us know now.
I see. I don't know if you see it, Brian, in the chat. It says, and we might need a little clarification, but it says, where would you go if you pay for the money to be added to your account?
I'm trying to decipher, where would you go to pay for the money? I need a little more. I'm not quite clear.
Like to help with your college stuff.
Okay, so if you wanted to pay money towards the bill, is that what you're asking? Yeah. Okay, so yes, almost every college offers a payment plan. So say you end up owing $5,000, all right, for the fall semester. And you're able to pay that. You would set up a payment plan with the college. Typically, payment plans are 4 months, so they would take that balance, whatever it is, 5,500, and they would divide it equally between the 4 months. You would then make a payment each month to pay off that balance. Or if you had the resources, you could just write out a check. Well, not a check. We don't really use checks. Oh, I guess colleges accept checks, but usually they can make a payment with a debit card or electronic fund transfer. So you don't have to borrow the parent loan. You don't have to borrow a private loan. You don't even have to borrow the federal loans if there is other resources to pay the balance. Did that answer your question?
Yeah.
Okay, good. Sophia, did I miss any other ones up here?
I don't see any others.
Okay. So again, just in conclusion, always remember, please borrow what you need. A lot of times now schools will let you borrow more than what you owe. I mentioned that earlier. There's nothing wrong with that. That excess money, again, would go back to the student, but I've seen it where, the student borrows more than what they owe. They get the refund to use for spring break, or they get the refund to, buy an Xbox. Not that those things are important, but we really want to try and limit the amount of borrowing. National student loan debt, it's a crisis. It is. Presidents, lawmakers, all are trying to address it. I know the current administration is looking to forgive about $10,000 of everyone's student loans, which is good, but it's not a solution. Colleges are going to continually increase their costs every year. Binghamton's no different. We experience a 1% to 2% tuition increase. It's rare when a college does not increase their tuition. But it's just a part of the industry. So if there's one thing that you take away from today, it's loans are a necessary evil. As I mentioned at the beginning, you go to college and take out the loan to get your degree, to get a job, and then that job will allow you to pay back the loans. So they're not a bad thing, but just do it responsibly. Do it where you're only borrowing what you need. And lastly, I just remembered, a lot of colleges will allow you to do a mix of financing. And when I say a mix, say you owe that $5,000 number that you wanted, that has to be paid. You've already taken out your student loans, and there's still a $5,000 gap. You mentioned the Parent Plus loan. You mentioned a private loan. You can actually set up a payment plan and have a parent loan at the same time. We don't care how the bill gets paid. We want to do whatever is best for the family. So say you can only afford $200 a month, okay, out of pocket. $200 over 4 months, that's $800. So instead of borrowing $5,000, you're only borrowing $4,200. So schools will allow you to do that. Everything does not have to be financed with a loan. I do encourage to take out, if you can, a payment plan. Even if you do $100 a month, that's less money that you have to borrow and less money that's going to accrue interest, and you have to repay at the end of your time. So again, loans are not a bad thing. Do it responsibly and borrow only what you need. Those are my last kind of bits of advice for everyone.
Great advice. Thank you again. We really appreciate it, Brian. Everybody else, if you don't have any other questions, thank you for coming. And we will see you soon at one of our upcoming presentations.
Great. Good luck, everyone.
Thank you.
Okay,
Thank
we'll talk
you.
soon. Okay, bye now.
Bye-bye.